all the other webinars that our colleagues are hosting across the country. You are free to go to any of those you're interested in. We also produce a podcast. So on our podcast page, we house all those historical recordings. So if there's something specific you're looking to get more information on or get smarter on, you might check the podcast page. And then lastly, just our website and blog, both of those just have a wealth of information. So again, if there's something specific you're trying to get smart on, you might go there and see if we have something to help you out. So with that, I'm going to turn you over to Malcolm. Thanks for joining us for our webinar today. And Malcolm, take it away.
Thank you. Thank you. Today's webinar is going to be very educational. We're not going to get into any products. It's purely going to be talking about IRAs, individual retirement accounts. And this is a vehicle that you will use in retirement, and you might be already using it. But these are the common questions that we come across that we're going to help you answer. How can I still contribute in retirement? And if so, how much? What type of IRA is right for me? When do I need to start withdrawing money? How much do I have to take? How are my IRA's withdrawals taxed? What happens if I die? How do some of the new tax laws impact me? And how can I minimize taxes when I take money out of my IRAs? So these are some of the questions that we're going to be talking about today. And another reason why we're talking about IRAs is if you think about 50, 60 years ago, retirement, when people retired, majority of those people had pensions. They received Social Security, and they really didn't need to save much for retirement because of the Social Security and pensions. Well, now pensions have gone, very little people have pensions today. And so that bucket that people have relied on is much smaller. You're still receiving Social Security, but now the hands are in it's more in the hands of you. You have to save for retirement because the money you're putting aside is going to be used to replace your income in retirement. So when it comes to these IRAs, they're more and more important because that's how we're going to replace income in retirement. So let's start first with just the basics of IRAs. The first one we'll talk about is a traditional IRA. Contributions they make are tax deductible, money grows tax deferred, and when you take money out, that's when you pay taxes. The maximum contribution for 2026 is $7,500, and if you're over 50, you can contribute another $1,100 for a total of $8,600. You must have compensation, earned income to be able to contribute to a traditional IRA. There is no age limit. There used to be an age limit, but if you're still working, let's say at age 80, you have earned income, you can contribute to a traditional IRA if you wanted to. Also, you have up to April 15th of 2027 to make a contribution into your IRA and have it counted in 2026. So that's very important to know. Now, there are certain contribution rules. For you to be able to deduct it, for you to be able to deduct it, there's some income limits that you have to kind of be aware of. If both you and your spouse contribute to a 401k at work, for you to be able to deduct that traditional IRA, your income needs to be below $149,000 as a married couple. As a single person, your income needs to be below $91,000. If your income is above those amounts and you put money into a traditional IRA, you're not going to be able to deduct that. So be aware of that. Let's talk about Roth IRA basics. When it comes to Roth IRAs, there's no deduction for contributions. Money still grows tax-free, and as long as you've had that account for 5 years and you're over 59 and a half, all earnings and interest come out tax-free. It's considered a qualified distribution. Now, the contribution limits are the same as traditional IRAs, $7,500 for a single person, $7,500 for someone younger than 50, $8,600 if you're over 50. You have to have earned income also to be able to contribute to a Roth IRA. There is no age limit either. But there is an income limit that says, hey, if you're over this amount of income, you cannot contribute to a Roth IRA. As a single person, it's $168,000. As a married couple, it's $252,000. So if your income is over these amounts, you cannot contribute to you cannot contribute to a Roth IRA. And there's the phase out window. But if your income is below 153,000 and below 242,000 as a married couple, then you are able to contribute to a Roth IRA. There is something called a spousal IRA, Roth IRA contribution. And what we come across this is, let's say you're a married couple and one person has already retired. They usually come in and say, well, I can't contribute to a traditional IRA or a Roth because I have no earned income. Well, as long as your spouse is working and has earned income, then you are able to contribute to a traditional or a Roth. Now, here's the thing. If your spouse is contributing to a 401k, and even though you're retired and your income, combined income is over $252,000, you're not going to be able to deduct that traditional IRA contribution. And also, if you're over certain income limits, you're not going to be able to contribute to a Roth IRA. But be aware that if you're under these limits, and let's say you're not working or you're retired, you might be able to contribute to a traditional or a Roth IRA for that year. Now you might say, well, it's $8,000. Well, $8,000, if you continue to contribute to it over time, it will start compounding and start growing. And that's what this chart is saying. If you're coming in and assuming I think they use a 6% rate of return, contribute $8,000 for 10 years, you can see the money start to grow and start to compound over time. So it does add up over time. Now, make sure you're taking advantage of your employer-sponsored plans, 401ks, 403bs, 457s. Because pensions have kind of gone to the west side, most corporations come in and say, hey, we have a 401k set up for you. If you contribute to it, we're going to match your contribution. So it's a great and easy way for you to save for retirement. This year, if you're under 50, it is $24,500 that you're able to contribute to. If you're over 50, you can do $32,500. Now, if you're between the ages of 60 and 63, there's a super catch-up that allows you to do a total of $35,750. So just make sure that if you're between 60 and 63, I would call your 401k provider and say, hey, there's a special contribution I'm able to do. And is the plan set up for me to make this extra contribution into the plan? There's also a new change for 2026. If you had an income over $150,000 last year, starting in 26, any catch-up amounts that you put into the plan will automatically go into an after-tax bucket or a Roth bucket. So just be aware of that. Because prior, you used to be able to put all that money in pre-tax. They changed the rule a little bit and says now, hey, if you're over 50 and you're maxing out your 401k, the normal contribution, which is $24,500, will go in pre-tax, but everything above that will go into an after-tax bucket as long as your income was over $150,000 last year. So it's something new, just to double check. Now, remember, whenever you put money into the 401k, if it's all pre-tax, at some point you're going to have to take that money out. When you start taking that money out, it's going to be taxed at whatever your current tax bracket is. So this rule or this thinking was, hey, put money in pre-tax because when you retire, you could be in a lower tax bracket in retirement. That sometimes is the case, but it's also, I've seen it where it hasn't been the case. So just be aware of what is your current tax bracket today and what do you think your current tax bracket is going to be in the future. Now, historically, if you look at tax rates, you could say we're in a low tax environment going back. I mean, just looking at this chart, going back to the 50s, the top marginal income tax rate was 90%. Right now, we're sitting at 37%. So historically, you say, hey, we're in a low tax bracket. What's taxes going to do in the future? Are they going to go up, stay the same, go down? They're either going to stay the same or they're going to go up. Now, there was this idea that taxes were going to go up this year because the Tax Cuts and Jobs Act was going to expire. Well, there was a bill that was signed last year that came in and permanently made the Tax Cuts and Jobs Act permanent. Now that just means there's no expiration date. Congress could come in 4 years, 8 years, and change the tax code, but Congress has to come in and do that. Do that. So not only did they not prevent taxes from going up, but they also expanded some deductions for families and seniors. We're not going to go into a lot of these changes. Next week, we'll talk more about taxes. Now, whenever you take money out of IRAs, be aware of certain side effects. And what I mean by that is it's not simply, hey, I'm taking money out of my IRA, I'm going to pay taxes, and all is good. That's where the IRS comes in and has these kind of tax traps that you need to be aware of. So whenever you take money out, be aware there's something called a net investment income tax. If you're a single person and you have income over 200,000, or you married couple and your income's over 250,000, they could impose a net investment income tax on passive income, which is dividends, interest, rental income. So again, it's really important to understand when you take money out of IRAs. If I take money out of my IRAs, how much? Where's that gonna move my bracket? You might be phased out of certain deductions or tax credits. Your Part B premium might increase because it's all based on what your modified adjusted gross income is. You might see more of your Social Security subject to tax because you took more money out of your IRAs than you expected. You might eliminate some financial aid. You might eliminate the ability to contribute to a Roth IRA. So it's really important to understand that when you start taking money out of IRAs, traditional IRAs, that's going to be taxable to you in that year. And how does that affect your overall taxable bracket? Now, the IRS comes in and says, hey, you can contribute to a traditional IRA or a 401k, put that money all in pre-tax. But at some point, we want you to start taking money out. And it's something called required minimum distributions. So even though you have this money in IRAs and 401ks, and you're like, I don't need it. I want to let it continue growing. Well, the IRS comes in and says, hold on, we've been giving you that benefit all these years. You need to start taking money out so we can start collecting taxes. Depending on when you were born, your RMD is either 73 or 75. If you decide, hey, I'm not going to take any money out, even though they require me to take money out, the IRS can come in and penalize you by 25%. So what that means is if your RMD was $10,000 and you decide, I'm not going to take it out, they could come in and say, we're going to charge a 25% penalty on that. So charge you a $2,500 would be your penalty for not taking your RMD out. Now, your RMD, your required minimum distribution, is based on the life expectancy number. And they look at what the ending value was the year prior. So hypothetically, let's say you turn 73 today and your RMD starts this year. They're going to go back and say your RMD is going to be calculated on what the ending value was on December 31st of 2025. They're going to take that number, divide it by your life expectancy, which is 26.5 years. IRS comes in and says you're going to live another 26.5 years. And that's going to determine how much you have to take out. Now, when you look at this factor, the first year is about 3.78% that you're required to take out. That percentage goes up each year because you're getting older and the life expectancy number goes down. So you can see, like, you might start at less than 4%, but once you reach age 90, it's 8.2% that you're required to take out in that year. Now, some of the mistakes that I want you to avoid that we come across are these three mistakes. First mistake is you're aggregating RMDs between different retirement accounts. So let's say you have an IRA and you have a 401k. Those are different retirement accounts. So you might come in and say, hey, my RMD is 5,000 from my 401k, 5,000 from my IRA, so a total of 10,000. I'm going to take 10,000 from my IRA and call it good. Well, IRA says, hey, wait a minute, you forgot to take money out of the 401k because it's a different plan type. You're required to take money out of that. So just be aware, 401ks and IRAs are different plan types. Now, when it comes to, you can have 10 different IRAs, and the IRS says, hey, those are all the same plan type. Plan type. We don't care where you take that money from. So you can take all of your RMD from one IRA. The second mistake that we come across is aggregating RMDs between spouses. So Bob and Sally, they each have to take out $10,000 from each of the IRAs. Bob comes in and says, hey, I took 20,000 out of my IRA, so our RMDs are good. Don't worry about taking any money out of your IRA, Betty or Sally. Well, the IRS says, wait a minute. These are individual retirement accounts. Each individual has their own required minimum distribution. So Bob has to take his own, and Sally has to take her own. The third mistake that we come across, and this is a more common mistake that we come across. I'm dealing with it right now with one of my clients, or a new client that I'm bringing on board. He had an inherited IRA. He was in the Marines. He was, in the last 4 years, he's lived in almost 8 different locations. During that time, he did not take any money out of his inherited IRA to meet his required minimum distribution responsibilities. And it's one, because he was just, traveling all over the place, being in the Marines and getting deployed, and he just forgot to do it. Well, this is a very common mistake that happens. So if you are subject to RMDs, make sure you're taking that out. Now, how you get it fixed is you talk to your accountant and say, hey, I forgot taking out my RMDs. They're going to say, make your IRA current, take up those distributions that you should have, and we'll just report it somehow and say, please excuse my mistake, my error, but I've rectified it and I've taken out what I needed to take out. Talk to your accountant about trying to avoid that penalty. But the third mistake is a common one we see a lot. Maybe you had health issues and you just forgot to take it out. Now, let's talk about some different strategies when it comes to IRA distributions. You could come in and say, hey, I've retired. This money that I have in my IRA, I don't need it. I'm just going to collect. I'm going to allow that to continue growing. So by doing so, you have that account that continues to grow. You're not taking anything out, so it's not being added to your taxable income. And maybe you're avoiding some of those potential side effects right now. But the downside of doing that is, think of it this way. Your IRA continues to grow. And if it continues to grow, what happens? Your required minimum distribution, when you're required to take money out, is much larger than if you started taking money out of the IRA at a slower pace. And who knows what taxes are going to be in the future? I mean, if you're 10 years from RMDH, I don't know what taxes are going to look like. Taxes might be higher than they are today. So that means that you not only are required to take more money out, but the IRS comes in and takes more of your money because taxes are higher. That's where we also talk about Roth conversions. Roth conversions is when you have an IRA and you say, hey, I'm willing to pay the taxes on that money and convert it over to an account where basically it's all going to live tax-free. Now, in this example, Jill converts $100,000. $100,000 is added to her taxable income in that year, And based on her other income, she's going to pay taxes on whatever her combined adjusted gross income is for that year on that 100,000. But now she's created a Roth IRA that, as long as she keeps for 5 years and she's over 59 and a half, everything within that continues to grow tax free. Now, I'm not saying everybody should do a Roth conversion, because we've definitely met with people where it does not make sense to do. But it's a strategy to look at and say, does it make sense to do Roth conversions to help reduce some of the future tax liability that you have in the future? Now, who can do Roth conversions? Well, anybody. There's no age limits, there's no income limits, and there's no requirement to work. At one point, there was an income limit. If you made over $100,000, you were not able to do Roth conversions. But the IRS says, hey, we kind of like that tax income. Let's let everybody do Roth conversions and let them do it, because we're willing to collect those taxes now. Now, 30 years down the road, they're going to say, oh my gosh, what did we do? Because there's going to be so much money in these Roth IRAs that's all going to be tax free. And then they're going to be like, is there a way we can figure out how to tax it? Hopefully that's not the case. Everyone gets grandfathered in, but that's something to kind of think about. Roth conversions can also reduce future tax rates. Well, think about it. If all of your money is in Roth IRAs and taxes go up down the road, well, all of your money is tax free. None of it's going to be subject to that higher tax rate. And also, when it comes to taking money out of IRAs, it's added to your taxable income, which could cause your Social Security and Medicare Part B premiums to increase. But if all of your money is in Roth IRAs, you don't have to worry about having your Part B premiums increase, or even having a lot of your Social Security be subject to tax. It just depends. Everybody's situation is a little bit different. Also, Roth IRAs have no required minimum distributions, meaning you control when you want to take money out. You can let that money grow for the next 30, 40 years. You have the ability to let this money pass on to your beneficiaries, all tax free. So, a lot of flexibility when it comes to Roth IRAs. Now, one thing that occurred that I still want to bring up, even though this has changed back in 2017, is that prior to 2017, you could do a Roth conversion and 6 months later and say, oh man, I shouldn't have done that. That was a mistake. The market went down 20%, and let's just undo it. But now they're coming in and saying the new rule they put in 2017 says, hey, if you do a Roth conversion, you're stuck with it. So if your tax bill is higher than expected, or you phased yourself out of certain credits, or the market dropped 20%, it doesn't matter. You've done that conversion and it is done. You cannot undo it anymore. So when you do Roth conversions, kind of think about, hey, do I have a general idea of what my tax bill is going to be? Do I have a plan to pay the taxes? And what's the expectation? What's the benefit of me doing the Roth conversions? If you have a general yes to each of these, then you're on your way to maybe doing a Roth conversion. But trust me, not everyone should do Roth conversions. We've definitely met with people where it does not make sense to do. The other kind of Roth conversion that we run into is something called filling up the bucket or bracket. So you have a certain amount of taxable income, and let's say you fill up the 22% bracket. You have another $50,000 before you go into the next higher tax bracket. You can come in and say, hey, let's convert $50,000. I'm willing to pay 22% on that, but I'm not willing to go into a higher tax bracket. That's the filling up the bucket strategy. Sometimes people come in and say, hey, let's go all the way up to 24 because I'm only paying 2% more in taxes, but I definitely don't want to go from 24 to 32. So it's up to you on how much you want to convert, because at the end of the day, you are the one writing the check to IRS to pay the tax liability on the Roth conversion. Other times where it might be smart or beneficial to do Roth conversions is when you have low income years. Let's say you retire at 65 and you're going to delay Social Security until 70. Maybe you're in a low tax bracket. Those are good years to do Roth conversions. Or maybe you're self-employed and you've had kind of a crappy year, low sales, low revenues. Maybe those are good years to do Roth conversions. Or if you have a lot of medical expenses that you're used to deduct, that you're able to itemize to lower your taxable income, those are good years to do Roth conversions. Okay, let's move on to talking about moving retirement money. Okay, you've retired, you have money in the 401k, and you want to move it to your IRA. What is the best way to go about doing so? And there's two ways you can do this. You can do an indirect rollover or a direct rollover. An indirect rollover is where you come into the 401k and say, hey, I'm going to take all my money out and I'm going to put it into an IRA. And they say, well, do you want a distribution? You say yes. So they cut you a check minus 20% in taxes, and you get a check for the remaining amount. You have 60 days to put that check back into your IRA to have that money continue to be sheltered. Now, the 20% that they withheld for taxes, if you want all of that to be sheltered also, you need to put that money back into the IRA also. Now, when you file your taxes, you're going to get those taxes back, but this is an indirect rollover. And it may not happen necessarily when you're taking money from 401k to an IRA, but I see it happen when you have an IRA, let's say at a bank, and you want to move that IRA to another bank. And you walk into XYZ Bank and say, hey, I have an IRA. I'm going to move it to another IRA at the bank. Can you cut me a check? And they cut you a check payable to you in the amount, and then you walk over to the other bank and you deposit it into an IRA, and money's in IRA. Well, that's considered an indirect rollover. And when it comes to indirect rollovers, you can only do that once a year. So if you took that money out of the ABC bank and deposited in an XYZ bank, and 6 months later you do the exact same thing, the IRS says, wait a minute, you can only do that once. So this second time that you try doing that, now we're going to tax all of it, and it's added to your taxable income. So be aware of indirect rollovers. The better route is direct rollovers. Direct rollovers is when you're calling XYZ company and say, hey, I'm moving my money into an IRA at ABC. And they say, okay, we're going to cut you a check payable to ABC, FBO, your name. As long as they do that, that's considered a direct transfer. Same with the bank. If you went to XYZ Bank and say, hey, I'm moving my money to ABC, make sure they cut a check to ABC, FBO, your name. With that, there's no 60-day rule. There's no 20% withholding, and you can do as many of these as you want because it's considered a trustee to trustee transfer. So this is just an example of what a check would look like. So again, there's two ways to do the rollovers, indirect, direct. Always encourage you to do the direct because then you don't have to worry about the taxes. You don't have to worry about claiming any of that, and you don't have to worry about the 1 year, one-time rollover. When it comes to IRA planning, it's still really important to plan. IRA is just one piece of your overall puzzle. You still have to think about taxes. You still have to think about how money's going to pass on to the next generation. Your overall financial plan. So the next piece we're going to talk about is it's not just what you own, but where you own it. Strategically allocating assets to certain accounts might be more beneficial than others. What do you mean by that? Let's say you have 100,000 in an IRA, you have 100,000 in a non-IRA account. You're in a 24% tax bracket, and each 100,000 in IRA and 100,000 in the non-retirement are invested in things that are producing about 4% interest. The IRAs, you have bonds that are paying 4% or CDs paying 4%, and then you have dividends paying 4%. So strategic allocation hypothetical says, hey, if you have 100,000 in your IRA invested in dividends, you're taking that $4,000 of dividends, you're being taxed at 24% rate. If you have 100,000 in a non-retirement earning 4% interest and you're taking that 4% interest, that interest is taxed at an ordinary income. So in essence, your total tax bill on that $8,000 of distribution is $1,920. Now, if you flip the script a little bit and say, hey, my IRA should own the CDs and my non-retirement should own the dividend stocks. And the reason for this is with 100,000 in CDs in the IRA, you're still getting 4%. It's still being taxed at ordinary income, but dividends and capital gains are taxed at a different rate. So the 4% in qualified dividends you're receiving are taxed at a 15% rate versus 24%. So now your tax bill is a total of $1,560. So you're saving almost $400 in taxes by simply having different investments in different buckets. So it's really important where certain assets lay when it comes to retirement planning. All right, let's talk about IRA planning and Social Security. Social Security is one of the biggest annuities you'll ever own. It's an income that you'll receive for the rest of your life, and it has cost of living adjustments to it. Now, the question becomes, should you take your Social Security or should you take money out of your IRA and delay Social Security to a later point? These are the questions that you kind of have to think about when making the decision on Social Security. Now, again, everybody's situation is completely different when it comes to this. And it is a personal choice if you want to delay Social Security or if you want to take it early. Social Security can be tax efficient because the most they're going to tax of Social Security is 85%. There's always going to be about 15% of Social Security benefits that's going to be tax free. This is an example of some of the planning that Kim and I do to help you understand, should you be taking money out of your IRA or should you delay it? And again, everybody's situation is completely different. This was a lady that came in, she retired at 67, or she retired at 66. Her full retirement age was 66. And she asked the question of, hey, should I turn on Social Security or should I delay till 70? She's single, no kids. And so we ran the first scenario, her taking Social Security at 66, and then we ran a second plan with her delaying Social Security till 70. And we laid them on top of each other. So you can see the dark blue represents her delaying Social Security till 70. The gray represents her just turning on Social Security. So her break even was 93, means that if she lives beyond 93, she starts to benefit delaying Social Security till 70. She's like, there's no way. I mean, I'm probably going to live till about 87. I don't see myself living beyond 93. So in her mind, it made sense to turn on Social Security early and start collecting that, that Social Security amount versus using her own assets. But again, everybody's situation is completely different, but we're able to kind of represent that and create a plan that shows, hey, is there any benefit using IRA money versus delaying Social Security? Okay, when it comes to IRA and estate planning, it's still really important. IRAs, you name the beneficiary on the account. Meaning if something happens to you, you name who this IRA goes to. No matter what you have in your will, it doesn't matter what you have in your will, the IRA company will say, hey, you listed your dad as the primary beneficiary. That's who's going to get it. Even though in your will it says all your money goes to your son. Doesn't matter. So it's really important to come in and review beneficiaries that you have on your IRAs. And there's different types of beneficiaries. You have eligible designated beneficiaries, non-eligible designated beneficiaries, and non-designated beneficiaries. There's three types of beneficiaries. The first one we're going to talk about is non-designated beneficiaries. These are non-living beneficiaries. So if you come in and say, hey, I'm going to name a trust, or I'm going to name the estate as my beneficiary, this is what happens. Let's say hypothetically, you name your estate as the beneficiary on your IRA. Well, if something happens to you before you started taking distributions, this money goes to your estate. Whoever's listed in the will. Let's say you have your sister listed in the will, because what's going to happen is money's going to go to the estate. Probate's going to have to be open. The judge is going to look into the will, and if the will says, "Hey, your sister inherits these assets," which is fine. This money now goes to your sister, but now your sister has to take that money out over a 5-year period. If she inherited this money after, let's say you passed away, but you had been taking R&Ds out, and it went through the same process, probate goes to your sister, then your sister now is going to have to take money out based on your life expectancy, whatever that is. So again, it's a much quicker distribution of those assets. So if your intention was, hey, my IRA is going to go to my sister, name your sister as a primary beneficiary so she doesn't have to worry about opening probate. Because if you named your sister as the primary beneficiary, now all of a sudden she's a non-eligible designated beneficiary. So usually non-spouse beneficiaries. And these type of people, once they inherit a IRA and you're a non-spouse, you have to take that IRA out over a 10-year period. So let's say hypothetically, my mom passes away. I'm the primary beneficiary on her IRA. I receive that IRA. I have to take it out over a 10-year period. You used to be able to stretch that IRA over my life expectancy, but not today. Today says, hey, if you inherit an IRA, you have to take it out over a 10-year period, which, depending on how much money is in the IRA, could you cause your taxes to increase. Now, there are still some situations where you have the ability to stretch the IRA. And this means that you just take money out over your life expectancy. If you're a disabled person, chronically ill, if the individual within 10 years of the deceased's age. So going back to my example that if your sister inherits your IRA and she's within 10 years of your age, she actually still gets to spread that out of her life expectancy as long as you name her as primary beneficiary. But if you named your estate, then she's going to have to take that out over a 5-year period or based on your life expectancy. So make sure it's properly named. If you name a minor child as primary beneficiary, they get to stretch that IRA until they reach the age of majority, and then at that point it flips over and they have to take it out over a 10-year period. So again, when we talk about beneficiaries, make sure you're updating it. Let's say you got divorced and you still have your ex as primary beneficiary. I don't know if that's what you want to happen. So if something happens to you, this money goes to your ex versus maybe the kids or someone else that you want this money to go to. So make sure you're updating your beneficiaries on your IRAs. You can name a trust as a beneficiary on your IRA, but they can be costly. But the biggest thing to name the trust is you want control. And what I mean by that is that if you have a son or daughter that they make $1 but they spend $1.50, you might want to come in and say, hey, if something happens to me, I'm going to put this money into a trust to control how much you spend each year. So with trust, you have a little bit of controlling power from the grave, or that might be one reason why you set up a trust. So again, if you're thinking about setting up a trust and you want to put your IRA within it, talk to an attorney to figure out what is the best way to accomplish that. Let's talk about spousal IRA beneficiaries. So married couple, one spouse passes away. You have two options. you have the option of, hey, I'm going to take that money and just put it into my name, treat it as my own, or I'm going to leave it as a beneficiary option, beneficiary IRA. So let's first talk about the first one. Your husband passed away, he has an IRA. You have the ability to say, hey, I'm going to take this money and just put it into my own name and treat it as my own. Now, if you do this, be aware that, again, if you're under 59 and a half, you're going to be subject to that 10% early withdrawal penalty if you needed to take money out. So if you are under 59 and a half, you might want to treat that IRA as a beneficiary IRA, because if it stays as a beneficiary IRA, then you can still take money out of that IRA and avoid paying that 10% early withdrawal penalty. Another reason that you might want to remain as beneficiary is that your spouse has, let's say 10 years difference between you. Let's say that your spouse, you're 75 and your spouse is 65. Your spouse that's 65 passes away. Well, instead of taking that IRA and combining with your own, you leave it as a beneficiary, and your RMDs on that IRA is going to be subject to RMD rules once they would have hit age 75. Or flip. Let's say flip the scenario. Let's say that your husband, that's 75, passes away. You might want to take his IRA and move it into your own IRA, because you're not going to be subject to RMDs until you turn 75 versus him already subject to RMDs. So there are some pluses and minuses to keeping moving the money into your own name or leaving it as a beneficiary IRA. Okay, I know we talked about a lot, and ultimately the thing I want you to understand is that we are here to help you answer a lot of the financial questions that you might run into, such as creating a withdrawal strategy, doing Roth conversions, when should I take Social Security? All of these financial questions we can help you with. One thing I like to look at is something like this, and you might have seen this before. It's climbing the mountain. Sometimes climbing the mountain, people say, hey, I'm working, I'm saving, I'm working, I'm saving. I've retired. I've reached the top of the mountain. Yay, we throw a party for you. But sometimes going down the mountain is the most dangerous. And I would say that's the same for retirement, because there's a lot of things that you don't necessarily think about while you're working that now you have to think about in retirement, such as, hey, is my Part B premium going to increase because of my income? Am I going to be paying more taxes? What about longevity or healthcare risk, inflation, the market declining? All of these things you never really think about until you're in retirement. So you have to watch out for some of these things. And some of the ways that we look at all these types of risks that you might be faced with in retirement is creating a financial plan. So Richard and Deborah came and saw us. You know, Rich is going to retire at 67. Deborah's going to retire at 65. Richard has some health issues, so we have life expectancy of 85 for him. Deborah's going to probably be on 95. They have assets in the 401k, savings, house is completely paid off. Their income while they're working, that we know what their Social Security looks like if they turn on at 65, 67. Richard used to work for United, so he has the PBGC. They want to live on $5,000 a month in retirement. We built in healthcare. Healthcare increases at a much higher inflation rate than normal stuff. Travel, they want to travel for the next 10 years after Richard retires. And we're looking at federal and state taxes. They are still contributing to the 401k, maxing it out and receiving a 3% match. So the first thing that we do is put these pieces together. And we say, hey, based on the income you have coming in, based on when you want to turn Social Security on, are you able to replace your income in retirement? And that's what this picture shows us. Picture shows the blue is their income, dark blue is Social Security, the teal is the PBGC, the yellow is the withdrawals that they're doing, the red is the required minimum distributions, and then when Richard passes away, we lose the Social Security benefit, but we're still able to replace Deborah's income throughout retirement up to age 95. We will then look at tax liability. While they're working, they're in a 22%. One retires, they're 22%. They have this window where they really don't pay any taxes, and then taxes come back into the picture because of required minimum distributions. They're in a 12% tax liability, but when Richard passes away, Deborah's going to be in a 22%, so her taxes are going to increase. So we said, okay, let's consider doing Roth conversions when you completely retire and see if that makes sense. And so we looked at filling up the tax bracket. We want to fill up the tax bracket up to 12% and stay within a 12%, see what the benefit would be. The yellow represents what we can convert in those years and stay within a 12%. And ultimately, we're coming in and saying by doing so, there's $112,000 that you are actually keeping in your pocket. That's money. Otherwise, if you didn't do a Roth conversion, that would be going to the IRS for them to spend any way they want. So not only do we help you reduce your taxes, but we also increase your net worth. Well, let's consider Richard delaying Social Security until 70. Is there any benefit of doing so? Well, break even based on this scenario is 79. We know Deborah's going to live beyond 79, so it probably does make sense to delay Richard's till 79, let Deborah continue taking her Social Security so that when Richard passes away first, Deborah will always get the greatest Social Security benefit. Well, Richard wanted to consider retiring early. Let's consider retiring at 62. Is that possible? Yeah, we're able to run this analysis and say, yes, if you want to retire early at 62, you're able to do so. All of that's happening is you're leaving less money to the kids. So it's your choice. If you want to retire early, yes, you can do so. So this is some of the planning that Kim and I do for members of the credit union to help you kind of visualize and understand your financial situation. And we come in and show you what's bad, what's good, what's bad, what are things you can improve, what are things that we can help you reduce your tax liability, and maybe you look at, is there a way to maximize your rate of return, but also at the same time reduce your risk? So with that, I'm going to open up to questions. I know I covered a lot of information. There's a lot of information when it comes to IRA planning, but Kim and I have been doing this for over 20 years. Each of us have been doing this for over 20 years. It's very rare that we come into something that we don't necessarily know about. I'm gonna also put a poll out there. If you